And the problem that I have with him saying it's a bad investment is that while whole life insurance is a bad investment in and of itself, what it does is it's an amazing savings vehicle. And so I'm going to get into that a little bit later, but as an amazing savings vehicle, what happens is it may not be a great investment, but it makes your investments better. And I'm going to get into, like I said, I'm going to show you what I'm talking about when it comes to this and how you can leverage whole life insurance. But the bottom line, when it comes to this, is that the first reason Dave Ramsey is wrong is because whole life insurance is not a bad investment, because it's not an investment at all. When you look at investments, investments take risk, right? Investments mean there's risk associated with it. If you invest your money, you can lose that money. That investment can go down in value all the way to zero. When you are saving your money, that money is guaranteed to be there. There's an element of guarantees that go along with it. And the only financial product in the world that will give you liquidity, use, and control of your money, that will have a return that beats inflation long term, and that you can keep access to that capital without putting it in a CD where you lose liquidity, without a fee, and without a bond that you lose liquidity to that money, where you have the guarantees. Whole life insurance is the only place it's like a bond alternative that's liquid. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I'm going to be talking to you about the 3 ways Dave Ramsey is wrong when it comes to whole life insurance. Now, if you watch Dave Ramsey, you're watching this video, chances are you've watched Dave Ramsey talk about whole life insurance. You've watched him battle with other life insurance agents. You've watched him ridicule people for utilizing whole life insurance and calling them stupid and all these different things. And so what I thought I'd do is I like to break this down and keep it really simple. And I have 3 ways that are really cut and dry, really clean about why Dave Ramsey is wrong, and I'm going to explain it. So before anything else, let's just get into this. So the first reason that I think Dave Ramsey is wrong when it comes to whole life insurance being horrible, a horrible place to save your money, or to put your money, or to invest your money, as he says it. The first reason is exactly that. Dave Ramsey calls whole life insurance a bad investment or a terrible investment. And here's the deal. This is kind of weird because I always say whole life insurance is a bad investment. So in that context, I kind of agree with him. But the reason I say that he's wrong about saying it's a bad investment is because it's not an investment at all. And so the deal with this is it's an apples and oranges conversation. You cannot ridicule whole life insurance for being this horrible investment, because Dave Ramsey's whole buy term and invest a difference concept, right? He's also really big on his baby steps and having an emergency fund and doing all these things with safe money and making sure your financial foundation is solid. And the problem that I have with him saying it's a bad investment is that while whole life insurance is a bad investment in and of itself, what it does is it's an amazing savings vehicle. And so I'm going to get into that a little bit later, but as an amazing savings vehicle, what happens is it may not be a great investment, but it makes your investments better. And I'm going to get into, like I said, I'm going to show you what I'm talking about when it comes to this and how you can leverage whole life insurance. But the bottom line when it comes to this is that the first reason Dave Ramsey is wrong is because whole life insurance is not a bad investment, because it's not an investment at all. When you look at investments, investments take risk, right? Investments mean there's risk associated with it. If you invest your money, you can lose that money. That investment can go down in value all the way to zero. When you are saving your money, that money is guaranteed to be there. There's an element of guarantees that go along with it. And the only financial product in the world that will give you liquidity, use, and control of your money, that will have a return that beats inflation long term, and that you can keep access to that capital without putting it in a CD where you lose liquidity, without a fee, and without a bond that you lose liquidity to that money, where you have the guarantees. Whole life insurance is the only place it's like a bond alternative that's liquid, right? And so I don't know about you, but from my perspective, that's kind of a no-brainer when you look at a product that's going to go 45 times better returns than your savings account over the long run. It just seems to make sense. And so that's the first reason. Now, the second reason that I think second way I suppose Dave Ramsey is wrong about whole life insurance, once again, it's not that he's wrong, it's that he kind of speaks out of both sides of his mouth, or he's speaking about it in context that he doesn't understand. And that's when he says you don't keep the cash value and the death benefit in your whole life policy. Now, what I want to do before I get into this, I want to give an illustration that shows what I'm talking about here, but I also want to talk about number 3, and I'm going to talk about number 2 and number 3 kind of at the same time, and I'm going to do it showing you an illustration of a whole life insurance policy, kind of proving the point of what I'm talking about here. So remember, the second way is that he says you don't keep the death benefit and the cash value. You only get the death benefit, so you lose the cash value. The insurance company keeps your cash value. We're going to leave that one for now, and I'm going to talk about it in a second. Now, the third way is he says a whole life policy is a bad place to save your money. Think about an emergency fund. Think about that rainy day fund and his baby steps. Think about an opportunity fund that you'll need, because he doesn't really talk about it a lot, but I'm a big believer that the best investors in the world have enough money safe and accessible for them to take advantage of when the opportunity strikes itself or presents itself. Because the bottom line is, look back to 2008 and 2009. 2009, more millionaires were created than any other time, and it's the people that had money in accounts that they at least operated like whole life policies, and they had liquidity use and control of that money to take advantage of the opportunity that it presented itself. And I'm also a big believer that we're coming into another economic environment like those times in the near future here, because look at inflation going up. I think we're going to have either the interest rates, because of the Federal Reserve raising interest rates, and it's gonna bring the economy down, or we're going to have an inflationary depression, because let's face it, inflation is just going to suffocate most families in America here. So that's that. So now what I want to do is I want to show you this illustration. All right, so when we look at this illustration, this is basically showing if you had money inside of a savings account. Let's just say you took $20,000 out of that savings account, and then you were committed. Let's say you were committed to saving $500 a month. That is, let's say it's going into your rainy day fund, right? Your options are saving money inside of your savings account and having your rainy day fund inside of your savings account and losing money to inflation. The other option is, when you look at this illustration, is to put your money in a whole life policy. Now, the one downside, and I do want to be totally transparent about this, is that you have to have a long-term vision. This will not beat inflation for the next year or 2 or 3. But by the way, neither will your savings account. So when you go apples to apples there, it is what it is. Neither one of them is going to beat it. But long-term, this is going to beat inflation. One of the things I like about them is that if you go back historically speaking, that in the 80s, dividend rates were much higher. Insurance policies operated much better. And it's very fascinating to look at the environment that we're in right now. And we're coming out of this environment where in 1980, the federal funds rate was 19%. And we've had a declining interest rate environment ever since. And so what that's done is it's put stress on a lot of fixed assets, which is where whole life policies get their returns from, get their dividends from, because that's what life insurance companies do. They manage risk. So you're not going to find another company, another investment organization in the world that's better at getting you the best possible returns, with the first priority being the preservation of capital, which is effectively meaning they're trying to beat inflation. That's it. Preservation of capital. That's all they're trying to do. And so this is an inflation hedged long-term savings account with ancillary benefits, with additional benefits, right? And so what I want to do is I want to show this to you. And so you can see here, year one, there's a cost of this long-term vision. You put in $26,000, let's say you had $20,000 in a savings account and you're saving $500 a month on top of that. At the end of year one, you're going to have $23,218 liquid. Now, so what happened there? You lost basically $2,800 of liquidity of your money, but you picked up a death benefit of $398,000. So this is where Dave Ramsey says you don't keep the death benefit and the cash value. So I want to address that right now. So here's the deal. This death benefit really isn't the $398. It's the $398, let's say minus $23,000. So let's just say it's $375. But here's the deal. You can see next year, because of the way that we have this policy designed, you put in another $6,000, right? And now you have a cash value that's gone up by $5,600. So once again, you're losing liquidity of almost $400 there, right? Because you put in another $6 and it only grows by $5,600. You have $28,000, but look at this. You only put in another $6,000, but the death benefit grew. The cash value grew by $5,600, but the death benefit grew by 10,000, so or almost 10,000. So check that out. So when he's saying you don't get to keep the cash value and you only get to keep the death benefit, the reason is because let's say you were saving this $28,000 inside of a savings account. If you die and that money passes on to your heirs, that's taxable. That $28,000 is going to be taxable. If you die and that $28,000 just gets absorbed into the policy, what they do is they keep increasing the death benefit here to make it so it passes through to your heirs tax free. So think about that. And the mind-blowing part, the part that frustrates me is that Dave talks about this just to create a story that matches what he's trying to preach, because he has a lot of great principles when it comes to getting out of debt and simple basics about managing money and being disciplined and, you know, living on less, you know, it just all these rules. I'm not going to get into all his rules. That's not the point of this video. So the bottom line though is when you look at this, you can see the death benefit is growing by the cash value, and you know, it is what it is. You start with 398. You have 87,000 at year 10. It's grown, right? Now you can see here in this example, I've reduced it. I've reduced the death benefit. And the purpose of this here is because we've done what's called a reduce paid up, because in this, there is a term rider to accomplish all this. But the bottom line, once again, you put in $90,000, that the amount you're paying for, you can see you're never paying another dime on this. The amount you're paying for is actually $76,000. The amount of cash you put in, I should say, is $76,000 less than the death benefit. Now, this death benefit, the base of this was less, and it was growing, it was growing, it was growing. And as the $90,000 grew, this started probably at just an $80,000 or $90,000 death benefit, and it grew up to this amount. And so, yes, you don't get to keep the 90 and the 160, but the cost, the amount you're actually paying for this insurance is not the 166. You're only paying for the spread. You get to leverage this $90,000 while you're alive. That's the powerful part. This is a living benefit. And if anything happened to you in year 1 through 10 here, if you become critically, chronically, or terminally ill, you're going to get all these living benefits where you get access to a portion of the death benefit while you're alive. So it's really, really powerful stuff when you really compare it and you look at it apples to apples. So once again, this is not an investment. This isn't going to rock anybody's world as far as the returns that it gets. There's no doubt about that. But you look at this, you put $80,000 into it over the first 10 years and you got $87,000 back. So you're ahead. You've got this free life insurance, essentially. It's not free life insurance. It's not really a compliant way to put it. So you're not really ever getting free life insurance, but the strategy is just leverage. You're getting your dollars to do more than one thing. So it's important to understand that. And the bottom line is when you do that, it creates leverage for you. So let's just say, this is why I'm a big believer in utilizing your savings, because remember, if this is a savings account, an emergency fund, I'm a big believer you should have an opportunity fund too. And so I would amplify these numbers. If you were looking at that, I would utilize this opportunity fund to get a real estate investment. Let's say you have $47,000 in this 5 years from now, and then the stock market and the real estate market take a dive because inflation and the Federal Reserve going crazy and all these things. When it does that, and I don't know if it's going to be 5 years from now or a year from now or 3 months from now, I have no idea, but I know it's going to happen. Like, it's just a matter of time. And so when that happens, imagine if you had this money, now you're going to be able to have leverage to be able to go out and get rental properties that you can buy low, that you can ride the markets high. Imagine what your life would look like in 2000, right now, if you were to able to go back to 2009 and buy rental properties again, your life would probably look completely different. Well, I got good news for you, is that there's another opportunity coming that's going to look very, very similar to that time frame, to that time period where the opportunity to create wealth doing that is important. About the only way you're going to be able to do it is not by having your money in mutual funds and in 401ks and stuff like that. It's having your money in a place where you have liquidity, you can control that money, where you've already paid the taxes, where it's growing tax-free, where you have tax-free access, and it's not where you're not in partnership with the government getting a tax deferral only to pay taxes later in a higher tax rate environment. That's the biggest thing. Remember, when Dave Ramsey fell in love with 401ks, it was the 80s when the top marginal tax rate was 70%. Ever since that point in time, the top marginal rate has dropped down into the 30s, and he hasn't changed the way that he talks about how to handle this stuff. And so, in my opinion, when the rules on the field change, you got to change the way you play the game, right? If you were a football player in 1988 and you tried to hop into the NFL today and play cornerback or whatever, the same rules, or if Michael Jordan hit the basketball court and tried to use all his hand checking and doing all that stuff that he used to play defense with, now when the rules are completely different, Michael Jordan would foul out of every game. He would have to adapt. If he kept playing by the same rules, he would lose, even though he's the greatest of all time, arguably. Not that I agree with that. Most people argue that. But even though most people consider him the greatest of all time, you know what? It's just one of those things. He would still do poorly unless he adapted to the current rules of the game. And so what I'm saying is the current rules today are different than back then. If you're following strategies for back then, you are putting yourself behind the 8 ball and you're likely not going to succeed. So that is, I mean, it doesn't need to get more complicated than that. I just wanted to share this with you. Remember, Dave Ramsey says it's a bad investment. I agree with him. It's not an investment at all. And so where he's wrong is really trying to pitch people on the idea that this is an investment. If anybody looks at any life insurance product as an investment at all, you are missing the target on what the purpose of these and how to utilize whole life insurance policies in general. You're missing the boat on that. So number 2, you don't keep the cash value at death benefit. I just showed you right here. You could see you don't keep the cash value, but the bottom line is the cash value grows and the death benefit grows too. And the way that we do that is we try to minimize the expenses. And the reason that they do that is to have you pass that money in a tax-free fashion. So when you look at the analytics behind it, it makes sense. When you look at the actual metrics, it makes sense. And then the next one, he says, whole life insurance is a bad place to save money. I don't know about you. When I look at this, if I had the choice to keep my money in a savings account or I could save it inside of a whole life policy and get all these additional benefits on top of it, that's a no-brainer. So anyway, if you have any questions, any comments, leave them in the comment section below. I always seem to get the most engagement on these videos where I talk about this kind of stuff about Dave Ramsey because I got so many people that are passionately following him. I know there's a lot of Primerica people out there that do this buy term and invest the difference and whole life insurance is horrible. I'm telling you right now, take a look at this, see what it would look like in your life if you don't utilize whole life insurance as the foundation of your safe, stable foundation of your and utilize it as the fortress of what your finances are built on. You're missing the boat. So anyway, have a blessed, inspirational day. We'll talk to you soon. See ya.